Hi Sundar, how are you doing?
I'm good, Sathya. How are you today?
Very good, very good.
So we get together for another interesting episode. Huh?
That's true, Sundar. Our last podcast on Bitcoin versus gold received a good reception amongst our listeners. So we
Fantastic.
wanted to take off from where we left.
Right. Yeah, but you guys, you really put me at a disadvantage because you gave a great action film with a fantastic climax in Bitcoin, and now we are going back to prehistoric eras of gold, right? So I'm hoping the audience will find this interesting. I'll try to make this as interesting as possible for them.
No, Sundar. Gold is always glittering. Gold is ever shining baby. So you always have your baby there.
Let's hope so. Okay.
We broadly want to cover some topics like how should investors should look at gold as part of their investment portfolio. Maybe if you want to start there, then we can proceed.
Yeah, maybe I'll come to that in a bit, Satya. So first, let us cover the history of gold because unlike a more recent asset like Bitcoin, gold has a very rich history, as you probably know, right? And the earliest known time when gold was really valued as a monetary asset was in 31 BC, by Emperor Augustus,
Oh,
who reigned in ancient Rome. So it goes as far back as that, right? When gold was really recognized as something very valuable. Coming to more recent times, which is again a little bit of history for us between 1000 and 1900, Great Britain, in 1257, Great Britain set the price of an ounce of gold at 0.89 pounds, which is really kind of an official rate of currency for an ounce of gold. That was probably the first time that gold was actually benchmarked to a formal currency, right?
when was it, Sundar?
In 1257,
Well,
1257. And most countries that printed paper currencies after that, they supported the value of their paper currency with gold, right? And this came to be known as the gold standard ultimately, right?
yeah,
And
yeah.
till the 1944 Bretton Woods Agreement, Great Britain kept gold at 4.25 pounds an ounce. And of course, then the US was a rising power at that time, and they also started using the gold standard. And
Okay.
in 1791, they set the price of gold at about $19.50. And in 1834, they raised it to about $20.50, etc. So slowly, as currencies evolved, even during modern times, relatively modern times, gold was recognized as a very valuable asset, which was actually pegged to the currency, right? But the tipping point really came when during 1933 to 37, when President Franklin Roosevelt made it illegal for U.S. citizens to own more than a small amount of gold coins, right?
Oh, why is that? Why is that? What made him to do that?
Okay, the reason for President Roosevelt actually, ban more than a certain amount of gold with the private citizens was that it was during the hard times. It was basically just after the recession, and they suspected that a lot of gold was being hoarded, right? And that was stalling economic growth, and it
Oh,
worsened the
okay.
depression, right? So they wanted to probably get more money into the system.
Okay. Spend, make people to spend.
Yeah, correct. Make people to spend. So essentially, the Gold Reserve Act of 1934, they halted the minting of all gold coins, and then they raised the price of gold to $35 per ounce from about $20 per ounce, right? And basically, the IMF was also around formed around the same time. So member countries were required to guarantee convertibility of their currencies into gold. So if you had a certain amount of currency, you should guarantee to the IMF and other authorities that, yeah, I have so much of gold reserves with me, and therefore this is the amount of currency I have in circulation. Right?
Okay, understood.
So that was the importance of gold as an asset at that point in time. Right?
Mm.
In 1971, President Richard Nixon basically closed the gold window. So effectively, what he did was he ended the US dollar's convertibility into gold. So there was no fixed exchange rate for the gold, and I think that was primarily the start of recognizing the US dollar as the fiat currency of the world, as the reserve currency of the world, as it is today, right? And then, of course, in 1975, the US government, they lifted the prohibition on individual ownership of gold and so on. And by the 80s, gold had hit a record high of $870.
Right. Okay. That's very interesting, Sundar. So it has a long history Unlike Bitcoin, which is a very recent history. Okay. So why do you think, is it necessary to hold gold part of an investor's portfolio?
I would definitely think so. See, first of all, gold, again, similar to what we discussed on Bitcoin, right? It has a scarcity value. There is only so much amount of gold that is available in the world. It is estimated that the total reserves of both in public and private hands and in government hands, it's totally about 244,000 tons, something like that, right? Out of which 57,000 tons is still under the ground. Gold production has not been easy. I mean, there are environmental concerns around gold production. It takes a lot of time to find gold under the earth, right? And on top of that, the mining process is also very, kind of very arduous. I mean, despite modern technology and equipment and so on. So it's not a very easily found material, and therefore it's got a scarcity value. Every country actually has had a history of accumulating gold in their reserves. For example, central bank's holding of gold is at a record high for 20,000 tons as we speak in end of 2020. To answer your question, should we hold gold? Absolutely yes. The question then becomes how much of gold do we need to hold, right? And the general expert recommendation is about 10 to 15% of your overall portfolio should be in gold.
Hey, Sundar, I had another follow-on question on gold. Do you think gold is a good inflation protection asset? What's your view on this?
Yes, it is in a way. Let me give you a couple of examples, right? I mean, fundamentally, gold should not. I think one of the very respected commentators made a very pertinent observation on gold. He said gold should be considered as a store of value, not really as an asset class, right? And that makes a lot of difference because in 1970, for example, if you were a US citizen and you had $35, you bought 1 ounce of gold and you kept it. Cut to today, you could have sold it for almost $1,800. Right? So it is a store of value, even in terms of an international currency such as the US dollar, which is considered as a world reserve currency, which means that every country should have some US dollars if they have to import oil, if they have to import other capital equipment, etc., etc. World over, US dollar is recognized as a currency which can be used in exchange for goods or services or whatever. Right? Against such a currency itself, right, you can see how gold has preserved its reputation as a store of value. Going by the example that I gave. Now, if you look at inflation, right, coming to your specific question on inflation, whenever there have been periods of very high inflation in the US, gold has outperformed the currency. For example, between 1975 to 1881, it was a period of very high inflation in the US, which was ranging. It started off from about 5%, it went all the way up to 15%, right? And gold at that point in time, from 1975, $250 an ounce, it shot up to $650 an ounce, right? In the case of a country like India or any other developing economy, where the currency is also inherently at risk, right, because of volatile flows and so on and so forth, deficits and so on, right? In the case of India, you look at it, 1990, 10 grams of gold was at 3,200 rupees. And now it's almost at 48,000 rupees. So it's gone up 15 times. So because of the currency variation, and it is true that many average citizens of developing economies and countries don't have access to the US dollar as an investment asset, right? They can't hold US dollars, or it's very tough to hold. Even now, even with liberalization and all that, it takes a lot of effort. You need to open an account, you need to declare to the RBI and so on and so forth. So it is difficult to own US dollar assets, whether it's shares or even the currency itself, or even a savings deposit in a US bank account. Right? In recent days, it's become much easier, but earlier it was much more difficult. Cut back to the 80s and 90s. Right. So for citizens of those countries, gold was a great asset class because it not only protected you from inflation, which is a result of a weak currency, and spending by the government, but it also kind of tracked a world currency like the dollar. So it was a proxy for the dollar in a way.
Okay.
Right. But imagine a country like Venezuela or whatever, right, where the hyperinflation. I'm sure any Venezuelan who kind of held gold was really protected in terms of wealth creation, right? As opposed to holding, let's say, a Venezuelan stock or fixed deposit in a Venezuelan bank account.
Okay, so then comes the question whether I should hold as a physical gold or should I hold, there are these days we have instruments like gold ETF or sovereign gold bonds which are issued by Reserve Bank of India. What is your preference, Sundar? What do you prefer? What do you say to the investor?
I would definitely say that if you have a longer term holding for gold, if you want to hold gold rather as a longer term asset, more than 5 years, then the sovereign gold bonds of India make sense.
Okay,
Because
okay.
in addition to having gold backed assets on the bonds, first of all, it's a paper format, so therefore you don't have any risk of holding, theft, storage, etc., etc. And in addition, it gives you a 2.5% interest every year, which is kind of a little lower than the savings bank interest, but it's okay. You are getting some yield on gold, which the other instruments don't really provide, right? The
Right,
other
right.
option of holding gold is through ETFs. Now, ETFs again, it's a paperless form, so therefore very safe, and you can hold it in a depository just as you hold shares. But ETFs, you can hold it if you are more into short-term trading of gold. For example, if you have a 6-month to 1-year hold view of gold, for example, when COVID struck, right, gold was around $1,200, $1,300, and suddenly it went up to $2,000, towards late last year. So if you are kind of a speculator, if you want to trade in gold, ETFs are a great way to do that because they don't have any longer-term holding period, just as the sovereign gold bonds have. But at the same time, they're very liquid. You can trade in them, and you can actually make money through trading as well as holding. I mean, you can use it for both purposes, but they don't give you any fixed return like the gold bonds do, right?
Okay, okay.
The more
So what do
traditional
you,
investors, actually recommend holding gold in physical form. So what they say is, come any crisis, right? Even if the central banks were to close down, governments were to be shut, exchanges don't work, and so on, you have a few bars of gold in your drawer or in your local vault in your house, right? You can always find that friendly gold dealer near your home who will actually exchange it for cash, which you can spend during times of distress. So
okay.
all the three are recommended. Depends on, number one, the holding period of the investor. The longer term the holding, better to go in for sovereign gold bonds backed by the government, great asset, yield some return. Or ETFs can be used for long term as well as for trading. And of course, physical gold, which is a good old way to store gold, right? I mean, have a little bit of that in that. So out of the 15%, I would say 2 to 3% physical gold, maybe 5 to 6% in longer term bonds, and the remaining in sovereign gold bonds.
All right, thank you. So, Sundar, we want to talk about the second topic, pertinent topic in the last conversations, and comparing Bitcoin and gold, and whether what is our view whether Bitcoin is another bubble to be burst, and whether as an investor should one prefer Bitcoin over gold, as because there's an increasing trend by looking at Bitcoin as a replacement towards gold. So let me give my perspective, what I think. So while I feel while Bitcoin has a lot of technology innovation, while Bitcoin or cryptocurrencies in world stand behind the technology backbone, but I still feel Bitcoin is another bubble to be waiting to be burst. And the primary reason I put forth is that it is a currency which is not federally governed, right? And it is not centrally, there's no government banking, there is no federal bank governs this particular movement of this currency, sir. So while Bitcoin had its spotlight because of this anarchistic movement against government and federal, I still feel it is not ready, and I still feel it's a bubble to be waiting to be burst.
So the governments ultimately want to take over, or at least control a significant part of any asset class. And I think that's where I share your skepticism on the valuation of Bitcoin and where it's headed right now.
So I'm all for the underlying technology and the digital form of currencies, provided they are centrally governed, they are governed by authority and not by private individuals. I rest my case there. Maybe I will want to invite Shiva in this conversation and see what his view, because he always been a great proponent about Bitcoin. Hey Shiva.
Yeah, hi guys.
Right.
It used to be that typically you would invest by putting your money in a bank and getting some interest rate, or putting your money in your company and maybe getting some dividends. But then over time, we started to invest in things that did not offer any interest actually. And gold is one of them, right? One of the early ones, and continues to be one of the big top ones. But primarily the investment in any asset which is not interest yielding. So there are so many companies that you invest in, none of them pay dividends. Why are we investing in those companies? Because we think that we are going to probably make a higher gain from their stock prices, right? So so we have always been in, having these types of asset classes where some you basically invest for gaining some kind of a dividend or an interest or some kind of a future value, and some you're just investing purely speculative, hoping that the price would go up at a future time. Correct?
That's right.
So
Yeah.
if we take that argument, Bitcoin is very much behaves like any of those equities or any of those other assets like gold. Basically, Bitcoin is a high risk investment, and that is demonstrated by its volatility, right? Like yesterday, for example, it swung all the way from almost 15%, from 65K to almost 52K, but sort of recovered over the weekend, and it's sort of inching towards its old highs. But that's volatility. As far as and actually Sundar talked about scarcity. Sundar talked about why some of these assets get higher in price over time is simply because there's scarcity. And definitely Bitcoin, as we discussed in the last podcast, has a cap, has at only 21 million. In fact, it's got a cap where gold doesn't even have a cap. And by 2040, all the Bitcoin there is will be mined. So therefore, that asset is going to be one of the most sought after scarce assets. For a certain class of investors, it offers a much higher upside. And in general, what I have been told, and you guys are masters of finance, so you know this better, is that it's good to have 1 to 5% of a portfolio in high risk speculative investment, because that's where you have opportunity to get wealthy, not just make more than what the inflation rate is.
Yeah, yeah, understood, Shiva. So you are resting a case on Bitcoin as a speculative asset, and it is as an investor's portfolio. What is commonly recommended is around 5% of the portfolios to be in speculative assets, and maybe the Bitcoin could be one of the high risk and high speculative assets. Okay, understood, Shiva. Okay, makes sense. So, Shiva, what do you think about this discussion these days? We keep hearing about this NFT. What is this NFT, and is it even a worth? Is it falling back behind the technology of blockchain?
Okay, NFT stands for non-fungible token, right? Non-fungible token. They're basically, a digitization or digitalization of some assets, right? And because it is digital in nature, it offers, the verifiability, right? The provenance, data provenance. It's very easy to establish. Um, for instance, if you take even your Pokemon card, or even if you take, for example, art, there is always this issue of forgery, fake art. So you always needed somebody to verify it, and typically you would go through certain auction houses like Sotheby, or somebody who can authoritatively determine the authenticity of that piece of art, and establish its or trace its provenance. So if you have NFTs which are digitally verifiable, they're indestructible because they're digital, right? And you cannot make copies; it'll be easily found out. So there, if you did all of that, then basically you have an asset which is unique, which is just one of it, and you don't need any middlemen to assess whether it is authentic or not. And you can directly basically sell it to a buyer. right? So you get out
Okay.
middleman completely out of the equation, and directly. And this is a very good example actually of how this all started. I don't know, for people who are familiar with Star Trek, they will relate to this. So in Star Trek, there is a Captain Kirk, which was basically played by this actor called William Shatner, who became very
Mm,
famous
mm,
for commercials after he retired from Star Trek, right?
mm, mm,
So
mm,
he issued, digital cards a year ago, or maybe 2 years ago. I don't remember exactly. Probably a year ago, I think.
mm,
And
mm,
on a blockchain technology, you talked about blockchain. So there was
mm,
this company called WAX, Worldwide Asset Exchange, that basically created this blockchain. And this guy issued these digital cards, and every card was sold for $1 or something like that, and all the money went to basically Shatner, right?
mm, mm,
So
mm,
these
mm.
NFTs are very exciting from that perspective. Again, it's very early in its thing, and the technology is still evolving, the blockchain technology, but it gives certain opportunities for for the same type of investors who are interested in having some speculative assets, right?
Mm,
So how does it happen, right? So today, just like in the cryptocurrency world, right? You have these exchanges. You have to buy
mm,
these currencies only through exchanges. Similarly, for NFTs, there are a couple of exchanges. Okay, so this
mm.
Wax I told you about, Worldwide Asset Exchange, that is one of the ones that people have used. There's another one called OpenSea that people have used, and there's something for NBA also.
Okay. Very good. Excellent. Okay. Thank you, Shiva. Thank you, Sundar.
Right.
It's been a very interesting conversation with the two of you. Sundar made a case, very good case, of why one should look at gold as in terms of their portfolio. 10 to 15% of the portfolio to be in gold, and in the forms like could be in the form of sovereign gold bonds or a gold ETF or a physical gold, depending on your tenor and what is your investment objectives are. And we also spoke about, I made a case why I felt Bitcoin is a bubble to be waiting to be burst, where I had a strong case of looking at the underlying technology behind Bitcoin and the cryptocurrency, which is blockchain. Shiva opened his case of Bitcoin to be a speculative asset in form of investors' portfolio for investors to create the wealth. One can look at Bitcoin as a wealth creation opportunity. And Shiva also made a point of Bitcoin technology, underlying blockchain technology for the NFT tokens, where new form of assets can be stored. So it was a very interesting conversation. I hope all of you who tuned in to listen to the conversation liked it. We love to hear from you. Please post your comments at help@alphabeta.io or the comment section below. Thank you and have a wonderful day and stay safe. Thank you.